Hey everyone, welcome back to G-Tech Finance. Let's talk about what the Federal Reserve said today, Friday, March 5th. And we're not going to hear from Jerome Powell, but we do hear from two members of the Federal Reserve. These are very important members because they are presidents of individual banks of different branches within the Federal Reserve System. And they help Jerome make policy decisions. So let's take a moment to listen to some of the things they're talking about. Put this article together and it's really insightful. So in front of me, I have the chart of the bond yields that you can see because otherwise the camera on my iPad would suck. But I'll go ahead and explain it to you. So here is where our pain began. The stock market right here, February 19th was really the last day that we had some good. It was a Friday, and then all of a sudden the stock market started selling off. And in part it sold off because Treasury yields started rising. And this wasn't even that rough of a rise. This slope right here where really got nasty was when the slope or the acceleration of the rate of the 10-year did this thing here. I mean, that slope is fast. It was rapid. And so this is when we began having our sell-off. We had a little bit of recovery on Monday when bond yields were actually at a lower point. But bond yields started rising again throughout this week. And when Federal Reserve Chairman Jerome Powell talked and spooked the market yesterday, we got a spike in bond yields here and the stock market rapidly sold off. I personally believe this relationship is going to begin to fall apart. Let me show you the relationship a little bit more clearly first, just by overlaying the S&P 500 on parallel. So you can see the relationship gets weaker and weaker, at least in my opinion, you can see so. Let's take a look here. Let's draw the one the relationship makes sense. So what do we see here right here? In my case, I colored it in orange. We see the chart having a spike and the S&P 500, or in this case, which is the blue line, plummets. We see that plummet there, it's really, really evident. And then look at this. I will erase for a second, wait. Let's take a different color. Look at the bond yields. Oh, there we go. Bond yields fall. And what immediately happens, right there, you see the S&P 500 goes back up, right? And we get this sort of like trading with, okay, when the bond yields go up, the stock market goes down. And this has kind of been training us to think, okay, all right, if you want to know what the stock market is going to do, just look at the 10-year Treasury yield. In my opinion, this is going to break. This relationship will not last long. And I think it's already started breaking today. Why do I think it started breaking today? Because take a look at this, folks. So watch this right there. And we know what the market did today, but the market was insane. The market opened. It actually opened green, but by 8. Actually, this I think is California time, but I'm in Lebanon, so it's not the same. Market started plummeting, so let's mark that for a second. The market started plummeting right here at 11 a.m. California time again. It opened up at 6:30, which is actually right here. But wait a minute, at 6:30, this is when the 10-year Treasury was at its highest. And this is when the 10-year Treasury was at its lowest, which is very, very odd, especially since we rallied into the close. So we had our most pain when bond yields were in the day at their lowest. Then we started rallying up into the close when we actually get bond yields going up into the close. Right, so in my opinion, the 10-year Treasury yield as a relation to the stock market, I think that's already starting to fall apart. I don't think it's going to work very clearly again next week. Why did we have the big run up? Because of that rate, that acceleration was so fast. But now we got it. We're used to it. Okay, it's priced in the market. The 10 years is going to go up over time. That happens. That's normal. That doesn't mean the stock market has to keep selling off. Well, what did the Fed say today? And this is interesting as well. It relates obviously to bonds. So Neil Kashkari, the Minneapolis Federal Reserve Bank president, said the following, quote, "If we were seeing a real uptick in yields, that would give me pause, that would give me concern of the amount of accommodation we are providing to the economy. And that the amount of accommodation we're providing is fading or it's reducing, and that maybe," he says, quote, "that might warrant us considering a policy response." They talk in tongue. So in English, he's saying, look, I see that the 10-year went up, but this isn't like a big deal because look, if the 10 years at 1.5 and inflation's at 1.5%, we really have a real return of 0%. And so we're actually not even seeing a real uptick in Treasury yields. We're just seeing a quick uptick. That's kind of what the Fed is saying here. They're like, look, we're not seeing any cause of concern here. Yeah, sure. All of a sudden, like, ticked up really fast. I mean, the 5-year Treasury bond ticked up so fast last week that it ticked up at its fastest rate in 10 years. That shows you how quickly it ticked up. And that was one of the things that really spawned this panic. Instead, Neil Kashkari says, and this is a great Reuters piece, we are not seeing much movement in real yields, but rather an increase in what bond investors are demanding for compensation to reflect rising inflation expectations. Again, fancy tongue, simplify this. Okay, so bond yields accelerate up. The Fed's like, okay, well, real yields are still low. So why is the Fed not doing anything? Well, because the Fed's saying, well, real yields are still really low. And remember, real is what the yield is, 1.5 minus inflation, which is around 1.5, and you're at 0. So real rate of return is 0. Normally, that would mean considering inflation. Anyway, so we've got Neil Kashkari. Look, dude, this is no big deal. Like, we're the Fed. We're trying to get people to expect 2% inflation. Obviously, in the course of our business of trying to get people to expect the 2% inflation, at some point, bond investors are going to go, well, damn, everybody's going to start expecting 2% inflation coming. I better start shaking some money on my bonds. I better start asking for a bigger yield in my bonds. Like, why would I take a bond at 1.2% if everybody's expecting 2% inflation? Well, hell, give me 1.6, otherwise I ain't buying. That's kind of what's happening here. And the Fed is like, everything's actually kind of going according to plan. Just because the stock market freaked out because bond yields went up a little too fast. Yeah, for you all little paper handlers, that's not our problem. This means I'm obviously heavily oversimplifying the Federal Reserve here. But again, when you listen to them, they speak in this foreign language that's bizarre. And if they simplify it, and let's see if they simplify their language at all. So Kashkari said Friday that the new framework is helping push inflation up and providing the kind of accommodation that we hoped it would. Yeah, no, still foreign language, but basically that is exactly what I just explained. Like, what's happening is what the Fed wanted to happen. They want inflation expectations to go up to 2%. The Fed's basically taking credit for what's happening. They're flipping the script. We're like, stock market tanks, and everybody's like, oh my God, where's the Fed? Okay, so, anyway, so this is basically the Fed responding like, dude, this is what we expected. So, no, we're not going to bail you out, you paper handlers. Anyway, then, we switched to a different president, St. Louis Fed President James Bullard. In an interview on Sirius XM radio, he said, quote, it's not matching up right now, that we need to be more dovish than we already are. In other words, again, in plain English, he's saying, yo, look, we're already telling you, the economy is indulgent and we're going to keep printing money and we're going to be at it. We're going to be at you, 0% rate for like on at least 2023. I mean, who would have told you that like 17 times by now? And I think that we might even keep rates low until 2024. We don't know how many more times and in different ways we can tell you that, but just because you all paper handlers is sad the stock market is going down, doesn't mean that we need to start printing more money. That's pretty much what James Bullard is saying. And so when James was asked, what about Operation Twist? Can't you just do Operation Twist and start buying longer term bonds? Because if you start buying the 10-year or 20-year bonds or the 30-year bonds, what's going to happen? You drive those yields down and you push yields down. Well, what's going to be good for the stock market, right? Bullard goes, dude, folks, the interest rate or the yield on the 10-year is 1.55. If you look at the 6 month before the pandemic, that's pretty much consistent to what the yields were before the pandemic. And those are still pretty dang low historically. And the stock market did fine then, did amazing. And not our problem that there's a little bit of a hissy fit going right now. And quite frankly, you gotta give it to him. He is not wrong. If I put up the 5-year chart right here, well, you can't see it, I'm really sorry. 10-year Treasury yields were, right before the pandemic, were like 1.8. We had a period here of 1.5 to 1.6. In October of 2019 and August of 2019, we bounced around in November 2019. We were like 1.7. Right before the pandemic, 1.78. And he's like, dude, 1.566. Like the stock market was doing amazing over here. The stock market was doing fine over here, the exception of the end of 2018, like right around here. And this is where the Fed's like, okay. We will stop raising rates. And that kind of led to that, stock market like, whoa. Okay, but that's different, right? And that's the Federal Reserve's discount rate. But I don't want to overcomplicate things here. The bottom line is that we want to take away from Mr. Bullard is Mr. Bullard is saying, guys, chillax. Long term, this is not a big deal. 1.55%. Bullard goes on to say the following, that he would be concerned by disorderly behavior in the Treasury market. Something panicky would catch my attention, but we're not at that point. Mr. Bullard was then also asked about the stimulus package. And he said that he is skeptical that a $1.9 trillion package would even get enacted. He thinks there's only a 50% chance of the stimulus package getting enacted. Now, I'm like 80 to 90 of it happening. Maybe more bullish than him, obviously. Let's stick to the Fed right here, not stimulus. I'm going to make right now another video about stimulus. So sticking to the Fed. We didn't hear from Jay from PayPal today. He's probably, half a fifth deep. Okay, no, I'm kidding. Jerome's doing all right. But when we listen to Neil Kashkari and we listen to Mr. Bullard, what do we get? We get a reiteration that what's actually happening in the market is pretty much engineered by the Fed. Maybe the Fed is just retroactively taking credit, like, see, we designed this, everything's going according to plan, everything's fine, but keep in mind, the Fed's job is not to pump the stock market, even though it seems and it feels like that's exactly what Federal Reserve has been doing since March. That's not their problem, and they don't care if stocks go down or go up. They care if the monetary system starts breaking, if banks stop lending, credit cards freeze up, auto loans stop happening. That freaks them out. That is a danger. We're not seeing that danger, is what they're saying. So they're saying we have no motivation right now to change anything, what we're doing, because what's happening is not a problem. And now, if we, Jen Psaki, circle back to the beginning of the video, when I talked about, starting to see this relation between stock market and bond yields fall apart, correlation between bond yield up, stocks down, it's entirely possible that next week it doesn't make sense anymore because the charts don't inverse anymore. And the yield's not going to matter that much anymore, hopefully. It's priced in the market already. I think next week the stock market is going to be in this position of, let's now assess the damage the hurricane happened. Last 2 weeks, let's assess the damage. Something still overvalued, sell it. Something cheap, buy it. And we'll see how the market reacts next week. So those are my updates. Hope you enjoyed them. If so, hit the like button, subscribe to the channel, and hope to see you guys next time.